Okay. So first, I would like to say a few things on our risk assessment tool. We have, unlike the sovereign debt rating here, we are measuring the country risk worldwide. So we are using both macro and micro characteristic factors. We are also using our own payment experience. So we have rating the countries with seven different levels from A1 to D. So A1 to A4 being the best, I would say, assessment, and B to C and D being more on, I would say, the more risky countries. In addition, since a few years, we have also developed another tool, which is called the Business Climate Assessment, and it helps to determine in countries whether the environment is favorable to investors, to exporters, if the legal system is fair, and also if the information, especially the financial information, is available and is accurate, which is not always taken for granted. So next slide, please. The next slide shows the world growth and also Coface payment incidence. So in the last 40 years, so we've seen, and that was mentioned by the previous speakers, that there is a periodicity, kind of cyclical phenomenon. Crises happen again and again. In the past, it used to be maybe every 6, 8, or 10 years. Now I think the time is shorter, and we've seen that with the last financial crisis in 2007 to 2008. We've seen that the period between the previous crisis and this crisis was shorter, and also the magnitude of the crisis was much more important. That's also something very, very important to notice. So the question is, are we heading to another crisis, or is this crisis is really different? Well, we think this crisis is really different, mainly because the recovery after the 2007 to 2008 crisis was very short, only 4 semesters, and now we have again experiencing a slowdown of the economy, and again an increase of the payment defaults. Can you switch to the next slide, please? Okay, so it translates in heavy indebtedness. Sorry. Can we say that it's different from previous crises? Well, it's a debt crisis for sure, but we have to determine which kind of debt crisis it is. So there are 2 slides here. The first one is about the corporate debt, and the second one is about the public debt. If we look at the corporate debts worldwide, what we see is that in 2 countries, mainly Italy and UK, the level of corporate debts is quite significant, but nevertheless, in the last 2 to 3 years, the companies have started to reduce their debt level, and the situation has improved. While in other economies, the corporate debt is still highly sustainable. So we can certainly say that this crisis is not a corporate debt crisis. On the public debt side, it's different. If we look at that, we see that since 2008, the public debt has significantly increased in a number of countries, especially in Italy. In the years 2009 and 2010, these 2 years actually rubbed off 15 years of efforts from the Italian government to rub off the public debt. And now it's again at the level of 1995, 120% of the GDP. So here from this slide, it's pretty obvious that this crisis is a public debt crisis. So is this different from the past, a situation where you have over-indebtedness? Not that much, because in the past, I mean, when there were financial crises, it was the next step from many governments was to use their fiscal policy to counter this crisis, and it actually helped to avoid recession in a number of occasions. So that's not so different. Maybe what is different is that before, in the past, I think there was a study made worldwide in the 20th the impact of this fiscal deficit, the debts reached about 80% of GDP on average. I think with the last crisis, it went up to 134%, so it's much higher, but it's something that happened already in the past. So what is different? Can you switch to the next slide, please? It's different first because it's a question of size, the size effects. If we take, for instance, we talked a lot about Greece, and about Greece. Greece is, for instance, the level of public debt for Greece is obviously significant, and but it's still manageable. I mean, it's only we saw that the share of the Greek economy compared to the worldwide is quite compared to the rest of Europe is quite small. So the impact is sustainable, and the rest of Europe could definitely be able to handle that shock. So it's more, I would say, a kind of a symbolic event. I think when it reaches Italy, it's a bit different. Italy, the size is more important. We've seen in terms of GDP. If we look at, for instance, Italy, if we take, for instance, the external debt of Italy is 9 times Argentina's debt in 2001, and it's 8 times Russian debt in 1998. So, okay, we heard that the Italian external debt is low, which is fairly true compared to the country. It's about 200% versus 400% in Greece. But it's huge, and it's quite unique when you compare to other countries that have defaulted in the past. The public debt is also very high in Italy. For instance, if you compare it to Eurozone, the public debt of Italy is 22% of the Eurozone, while it's only 4% in Greece. So definitely the size effect is very important in that current circumstances. Maybe you can switch to the next slide. So we've seen that the size effect is here. And we see here also that another impact is the financial integration among European countries. So if you could see, for instance, the exposure of banks with different countries, we see that on the different slides, the exposure of European banks towards over European countries is very important. For France, Germany, Italy, and Spain, they have all deep exposure on not only on European countries, but also on US or especially on US. So you see that this aspect of integration could accelerate the crisis impact. Next slide, please. So that translates into a reduction, kind of credit crunch from banks. We've seen that in the last few years, the banks have started to reduce the loans to the corporates. On the left side, you have the European countries, the peripheral countries, and we see that all these countries, all the corporates in these countries have suffered from credit crunch. And on the right side, you have the core countries from the EU, France, Germany, Italy, plus UK, which doesn't belong to the Eurozone, which is also part of Europe. The problem with Portugal on the one hand and France and Italy on the other hand is that the corporates are more dependent on bank loans. So if the credit crunch, if there was a significant credit crunch and banks continued to reduce the loans to the corporates, for sure these countries, Portugal on the one hand, France and Italy on the other hand, would suffer probably even more than other countries. Next slide, please. So that translates in confidence in European sovereign countries. That's about manufacturing industry confidence. You've seen that after 2009 there was again an improvement, but the confidence has slowed down significantly, especially in countries like Italy or Spain, or also in countries like France and Italy for the core countries in Europe. Sorry. Next slide. What about our payment experience? Well, it's not a surprise to see that because of the crisis, we have experienced degradation of our payment experience. If we look at that's on a period between last summer and this spring, we see that globally payment incidents worldwide have increased by 27%. The increase was bigger in the Eurozone, 31%, and it was much bigger in Southern Europe, including Italy, Spain, Portugal, Greece, and also France in that category. While we see that our payment experience in US has remained fairly good, with only a 2% increase of payment incidents during that period. Next slide, please. So, as a conclusion for Europe, we expect a slight recession in the Eurozone this year because of recession in the southern European countries, in Greece, -6%, in Portugal, -4%, in Italy, -1.5%, and in Spain, -1.2%. Growth should also significantly go down in France and Germany, but we expect, nevertheless, a slight positive growth for 2012, 0.3% in France and 0.7% in Germany. Next slide, please. So we crossed the Atlantic Ocean to go to United States. And, well, US is a different situation. We see that there is a better resilience to the crisis in United States. From two angles, we can see that on the corporate side and on the household side. On the corporate side, we see that the business investments and credit corporates are trending up in USA. The companies are not overloaded with debts. They are sitting on a high amount of cash. That's what Rajiv said before about US companies. But I would say that at this point we have to differentiate the large US corporates that show very healthy balance sheets from the SMEs that suffer much more. And why do SMEs suffer much more in USA? For a simple reason that they heavily depend on regional banks, US regional banks that have been badly hit by the construction crisis. So in 2012 we expect more defaults from regional banks, which in turn could impact the American SMEs. The second aspect is about the household savings. We see that consumption has resisted well last year because of a number of reasons. Tax cuts, which have been maintained, unemployment benefit duration, and also the fact that the US consumers have used their savings to spend more, especially end of last year, buying cars. So it was, I would say, a good surprise. So all in all, better resilience than expected. But nevertheless, there are big challenges for the future and for the companies. The companies will have to get used to a less dynamic growth in the future and a more durable, cautious consumer trends, especially because of the structural unemployment in USA. Now the level of unemployment in US is almost the same as in Europe. It's about 9% today. And if we take the precarious job, it goes up to 16%.